Good morning and welcome to Accounting in the Morning. My name is Giamukhetswe and today we'll be discussing with various panelists from across the country ShopTite Limited's acquisition of preference shares in its subsidiary Adams Limited. ShopTite Limited already has a 75% stake in the issued ordinary share capital of Adams Limited, its subsidiary, granting ShopTite Limited control over Adams Limited. Adams Limited is therefore a subsidiary of ShopTite Limited, the parent. The acquisition of preference shares will have no effect on the degree of control as these shares do not normally carry voting rights. The nature of preference shares are such that they enjoy preferential rights over other types of shares, as an entity would have to declare dividends for preference shareholders first, and only if distributable reserves remain can ordinary shareholders be paid. They also enjoy repayment of capital during the liquidation of the company. Before the parent's acquisition of preference shares, the preference shareholders' equity attributable to non-controlling interests will be the sum of the preference share capital at fair value, any dividends in arrears, and any profit attributable to preference shareholders for the current period. The parent intends to purchase 60% of the issued cumulative preference shares of the subsidiary at either the beginning of the parent's financial year, the 1st of January 2010, or during the financial year on 31st June 2010 for consideration of 45,000 Rand. Tabisile Ndumo is joining us from Durban. Would you care to explain to our viewers how some of the measurements are performed if the acquisition occurs on 1st January 2010 with the use of our prepared example?
Thank you, Giamukhetswe, and good morning. Upon acquisition, we would have to determine the percentage interest of preference shares acquired by the parent, which was stated to be 60% in this case. It is important to note that this percentage need not be the same as the percentage interest in the ordinary shares. Cumulative preference share capital as an equity item represents the net assets attributable to the preference shareholders and was already measured at its fair value of 50,000 Rand as stated on the Statement of Financial Position. This amount is to be split between the interest attributable to the parent, that being ShopTite, and the non-controlling interest. We would usually use an analysis of preference share equity of Adams Limited to carry out our calculations. We would therefore determine the consideration by the parent and the non-controlling interest, and then the consideration of the parent is said to be at a cost of 45,000, and the interest of the non-controlling interest is always measured at fair value because at liquidation, the non-controlling interest is entitled to a repayment of capital but not a pro rata share of the net assets. The fair value of the non-controlling interest was 20,000 Rand. The difference between the consideration plus the non-controlling interest and the net assets attributable to the preference shareholders gives rise to either goodwill if the consideration and the non-controlling interest exceed the net assets attributable to the preference shareholders, or else a gain from a bargain purchase if otherwise. This may be offset against the goodwill or the gain from bargain purchase that arose from an interest in the ordinary shares previously acquired. Over to you, Gia.
Thank you, Tabisile. We do know that we're dealing with a group, and in that case, we would have to carry out a consolidation process where the equity of the subsidiary includes the preference share capital. Maschaba is in Polokwane. What would this process consist of?
Thank you, Giamukhetswe, and morning, everyone. The consolidation process is carried out every year from the scratch as the parent and the subsidiary prepare separate financial statements each year by way of preparing pro forma consolidation journals. In the case where the equity of the subsidiary includes preference shares, we first want to determine the cost of the investment in order to eliminate the cost of our investment against the net asset attributable to preference shareholders, as we cannot recognize an investment in ourselves in the group's financial statement. The investment in the subsidiary was recognized at its fair value, where the difference between its cost and fair value was recorded in the mark-to-market reserve. We will therefore reverse the difference attributable to preference shares in order to return the investment in the subsidiary to cost, as can be seen in Journal 1. The elimination of the cost of the investment can now be done by reversing the recognition of the preference share capital against the cost of the investment while taking into account the recognition of the non-controlling interest and goodwill that arose on acquisition. This is seen in Journal 2. Tavisile explained that the goodwill or gain may be offset, as seen in Journal 3, and therefore, if the net amount was goodwill, we will recognize it in the group statement of financial position, or if it was a gain, it will be included in other income in the group statement of profit or loss and other comprehensive income. If the gain arose in the current financial year, it will increase the opening retained earnings amount disclosed in the group statement of the changes in equity. We will now move to Lindo and Brian in Cape Town studios.
Thank you, Masichaba. We have chosen to focus on cumulative irredeemable preference shares, but there are numerous types of preference shares. These cumulative preference shares are entitled to a dividend every year, and in the years that no dividend is declared, an arrears arises. Whenever a dividend is then declared, the dividend in arrears would need to be declared before that year's dividend can be declared. In the event that there was an arrears at acquisition, this would have increased the preference shareholders' equity attributable to preference shareholders. If, for instance, the arrears was 7,500 for 1 year at acquisition, the following adjustment to the analysis of preference share equity would have occurred. The increase in net assets attributable to preference shareholders because of the arrears at acquisition reduced the goodwill, as the consideration and NCI remain unchanged. Because these dividends were not declared, they were not recognized as a reduction of the retained earnings in the separate financial statements. It is for this reason that we are going to reduce the retained earnings amount in the analysis of ordinary share equity of the subsidiary for the period in which the acquisition of preference shares occurred, as shown in the analysis. Non-cumulative preference shares never have dividends in arrears, as they are only entitled to dividends that have been declared.
If the parent company pursues the option to acquire the preference shares during the financial year on 30 June 2010, that will qualify it as an interim acquisition. The net asset value of the subsidiary that acclimated up to the date when the parent acquired its interest should be shown as part of the acquisition equity and should be eliminated against the investment of the subsidiary. Up until the acquisition of the preference shares by the parent, the preference shareholder equity belonged to the non-controlling interest. That's why 100% of the share capital are allocated to the NCI. The NCI is also entitled to 100% of the dividends accrued to the date of acquired, if we assume that it accrues evenly throughout the year. The profit attributable to preference shares being the NCI is shown as 3,750 in the current year, which increases the net asset value of the subsidiary as shown in the analysis. The parent company will then proceed to acquire the 60% of the net asset amounting to 32,250, which is also shown in the analysis. The difference between the consideration and net asset value acquired will usually give a rise to goodwill or gain on a back-end purchase. But in this case, if the consideration exceeds the net asset value acquired, a loss will be realized, which will cause a reduction in the return earnings during the current financial year in the statement of changes in equity, because there was an additional consideration that was paid. This loss amounted to 12,750 in our example, as it's the difference between the consideration of 45,000 and the net asset value amounting to 32,250. If we had the gain, then there will be an opposite effect.
The consolidation journal remains similar, but a notable change is the elimination of the investment in the preference shares as shown in J4, where the NCI was reduced by the stake they have given up and retained earnings were reduced as we explained. That's it from us. Back to you, Kiamukhetsu.
Thank you.
Thank you, Brian. Please follow the link in the description for the full example we have prepared for you. Thank you for watching, and a special thank you to the FRK 321 team for this amazing opportunity.